The S&P 500 is up nearly 8% this year, 2023, but unease around the underlying strength of the rally is almost palpable. JP Morgan's equity analysts estimate that the breadth of the US equity rally is by some measures the weakest ever, with the narrowest leadership in a rising stock market since the 1990s. Microsoft and Apple alone are behind 2.3% of the S&P 500's gain this year, 2023, and now account for a record 13.4% of the index, the most ever for the top two stocks. There's a rotation into perceived safety, that is bigger and steadier stocks, and a heading into anything that is perceived to gain from the hype around generative AI. JP Morgan's equity strategists argue that the AI theme appears to be stretched, given how it's generated around about $1.4 trillion of market capitalization this year, 2023. The overall conclusion is that stocks are whistling past a possible recession. Okay, so this is the emphasis they have in that regard, even though some may argue that there isn't really enough evidence to support a possible recession. But this is their own emphasis and their own opinions. So they went on to say the current degree of crowding implies the risk of recession is far from priced in. While in 2021, a broad market rally led by cyclical factors, growth and value, drove concentration to the highest level seen since the 1950s, the current market concentration episode is less constructive for the broader market, given that mega cap crowding with market cap of the largest 10 stocks relative to S&P 500 at 96 percentile relative to history. This is figure 1 here. That's an indication. You can see that 96 percentile of the top 10 stocks. That is where they are, roughly around 30% of the S&P 500. So weight of the largest two stocks as a percentage of the S&P 500 is at new highs. Last quarter's performance was led by the narrowest leadership ever in an upmarket. Okay. So popularity of ChatGPT was a catalyst for beating up select AI stocks to a record concentration and contributed to low breadth move up in major indices. Year to date, these 6 LLM innovative companies, that is Microsoft, Google, Amazon, Meta, Nvidia, CRM, explain 53% of S&P 500's performance, 54% of the Nasdaq 100, and 68% of growth factor, and defensive rotation ongoing with rising correlation of momentum with low volatility / quality, while the correlation with value is also collapsing at the same time. So they asked, why is the stock market not just buoyant but also calm? In a separate note published yesterday, the 26th of April 2023, JP Morgan analysts dug into the odd lack of choppiness, with 1 month realized volatility for the S&P 500 falling to 9% for the first time since 2021. They argue that volatility is artificially low, primarily because of option dynamics and pro-cyclical nature of volatility targeted investments. And then they went on to say that they believe the reason for low volatility are technical in nature, with the market dominated by option sellers. Selling of options forces intraday reversion, leaving the market price virtually unchanged for many days. You can see what we've been able to dig out here. Okay, so sale of options can potentially contribute to intraday reversion, as it involves the creation of new supply and demand levels in the market. When an option is sold, the seller receives a premium, which can be used to offset losses or to generate profits. However, this is also This also creates a certain pressure on the underlying asset, which can lead to a temporary decrease in price. So that is what the reversion they are talking about here. So this in turn drives. You can see that at the same time, when it reduces, it increases volume and probably reduces the price. As they're saying here, this in turn drives buying of stocks by funds that mechanically increase exposure when volatility declines. You can see that. Okay, so when volatility declines, some funds buy, and that's probably what they are pointing out that is going on right now. It's volatility targeting and risk parity funds. So this market dynamic artificially suppresses perceptions of macro fundamental risk. You can see that. So that's why they're saying that with all of these things going on, the market risks are suppressed, the macro fundamental risks are suppressed. Okay? So the low hurdle rate and robust fundamentals bode well for the first quarter earnings results, but they advise using any market strength on reporting to reduce exposure. Okay, so that's what's going on with the S&P 500, and there's also an index that usually SMH ETF. Let's see where it is now. SMH ETF, VanEck Semiconductor ETF. Okay, it's let's see it on our trading view and see where it is. SMH. Okay, this is the 1 minute chart. As a matter of fact, this is what's going on live. You can see it spiked. There's a spike here, but let's look at the daily chart and see what we have there. Okay, the broader market is also spiking at the moment. Okay, let's see SMH. Okay, SMH, it's declined of late, just of late, as of the whole of this week. It's been declining, but before that it was pretty much moving sideways, but even at that, broadly speaking, it is still very much holding up, at least above its this low as of 13th of the 13th of March. Okay, yeah. So see what you make of all of these, and I'll continue to update you. Thank you very much for watching this video.